Ladies and gentlemen, welcome back to the channel. I think we really need to talk as soon as possible because this, I think, is a very tricky market for a lot of investors, especially with investors that maybe are newer to the markets or a little bit more emotional. Right now is a time you really want to take the emotions out of the equation, okay? Really, the less emotion you have in your portfolio, the better you're going to do. That's just a rule of thumb. The more stoic you are, the better, okay? And right now we're in a very interesting moment. There's a lot of things happening, okay? And we're going to talk Tesla specifically in this video as well. But let's just break it down quickly. What do we have? We have a government shutdown and basically a data blackout. We have no idea, generally speaking, how the economy is doing, how the labor market is doing. Sure, we got American Express earnings today. They said good things. We got bank earnings. They said good things about the consumer and about the economy. Yes, they did hint at things can change, but as of now, they look good. But we have a black hole, if you will, in terms of economic data, in terms of judging this economy. That's not ideal, certainly right now, where some people, would make the argument that this economy is like late cycle, okay? So that's going on. We have a newly founded regional bank crisis, reminiscent of 2023. That really dinged the markets yesterday. And we have U.S.-China trade tensions and a trade war with China. That's not great. So you have three big things happening right now. And then you have a day like today where we got a lot of positive headlines out of the China-U.S. trade situation. Donald Trump said, hey, look, these tariffs are probably not going to go into effect on China. They are unsustainable, and both sides are basically saying they want to talk. Well, what happened today? The Russell still sold off close to 1%. A lot of AI stocks sold off today. And people, I couldn't even tell you how many videos I've seen collectively on YouTube from other quote-unquote content creators and CNBC that are talking about the AI bubble popping. It hasn't. I agree with a lot of them. We are in a bubble, but we are in the very early stages of a bubble. Very, very, very early stages of a bubble. Okay? We're not even going to be talking about a potential bubble popping for over a year from now. Like, the bubble did not pop. The bubble is just bubbling. Okay? Like, I was going to make a stupid analogy. Like, if you're trying to boil water on the stove, you just crank the heat on. Okay? Nowhere close to popping nor evaporating all the water. We're just not even close to that at this point. And I can make a video on specifically just that if you guys would like to kind of hear about it. But bubbles don't pop for no reason. Okay? Bubbles pop because of overinvestment into technologies that are either way too premature or never have a total addressable market in which they were being given credit for. Okay, what do I mean by that? Well, sure, mega hyperscalers are investing in AI hundreds of billions of dollars a year. There is use cases for that, whether it's saving money today or growing revenues in the future. Okay? What about robotics? Does nobody think there's going to be a massive market for robotics from a military application, from a healthcare application, from a personal application, commercial applications, and many others? There's infinite use cases for AI robotics. Okay? We haven't even gotten to hype around AI robotics yet. When that's the case, we'll be talking Tesla at $2,000 or $3,000 a share. Then we can start to make arguments whether, expectations are too high for certain things. Now, one thing you got to remember is the bubble is not equal, okay? This is a very lopsided bubble. There's certain areas that are going to get bubbly first. First, it was semiconductors, where a lot of people said NVIDIA was in a bubble at $100 a share, 200, 300, 400, blah, blah, blah. But the company kept growing into it, okay? So we now know that NVIDIA was not in a bubble at $100, $200, $300, blah, 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 okay? Or pre-split, it was, $1,000, okay? $1,600 would be the price before their last split, okay? A lot of people called NVIDIA a bubble for a long time. It was proven not to be. Okay, there's going to be waves to this. There's going to be software bubbles. There's going to be maybe quantum bubbles. You can make an argument that we're kind of in that, although that's not directly related to AI. It's kind of adjacent to that. There's going to be AI bubbles. And I think to a certain extent, some of those areas did get a little bubbly, right? A lot of pre-revenue nuclear companies not even coming to market with any revenue or energy for years that are trading at crazy valuations. There's an argument that maybe some areas have already seen a little bit of that bubble. But the larger bubble does not pop until we get to the end stages of AI, which is many years away from today, right? Once we get to like robotics or healthcare AI euphoria, that's when the bubble, you got to start looking at things and saying, okay, maybe this is a little overextended. But again, the total addressable market for robotics AI is so large that some of these robotics companies like a Tesla are going to be $2,000-$3,000+ a share before we're talking about an AI robotics bubble popping, okay? But there's going to be waves to this, just like there was in even 2021 or in the dot-com era, okay? So maybe you've seen a sector or two get a little bubbly, okay? I wouldn't say pop, but a little bubbly and kind of holding on to that bit of a bubble, okay? That's my broader thesis on the bubble, okay, and why it has not popped yet. Now, Renaissance Macro Research, led by Wall Street's most decorated and longest tenured technician, Jeff DeGraff, previously worked at Merrill Lynch, Lehman Brothers, and ISI before founding RenMac in 2010. This is a firm that's gotten a lot of attention recently. They went on CNBC, Jeff DeGraff, and said 10-year yields below 4% is really good news. He talks a lot about the bubble in this clip. It's about 4.5 minutes long. He talks about the bubble, that it's not popped, that we're certainly in a bubble or heading down that road, but it's going to take a long time for the bubble to actually pop, and he doesn't even think we're even relatively close to that. Okay, so we're going to share this clip in just a few minutes, but I want to talk specifically about this market. Again, we had a weird reaction today in stocks based on the China headlines, based on the fact that the KRE was actually positive today, meaning the regional banking crisis fears did not grow. The KRE was up 1.5% today. Even to me, it's a little bit of a head scratcher to why the Russell, why AI stocks, why, some of your momentum names sold off today. The only thing I can even really point a finger to is some of the fears about a bubble. But again, we are not in a bubble. There is basically forced AI competition right now, because if Google does not compete, they die. If OpenAI does not compete, they die. If XAI does not compete, they die. If Microsoft does not compete, they die. Okay? Same goes for smaller companies. And that's on a country level, right? US competition internally. But then you have competition with China, right? And that is a driving force. Before this bubble, quote unquote, pops one day, you're going to see China potentially take the lead over the US in AI. And then the government's going to be giving away hundreds of billions of dollars in free money for private companies to compete. This whole AI thing, just say it in simple terms, is either going to lead to a massive collapse of the U.S. economy, or it's going to lead to greatness like you've never seen before, and wealth creation where if you're involved in markets, you're going to get insanely rich. There's no other outcomes besides those two in my view. Now, do you take the over? Do you take the under? Are you betting with America, or are you waiting to bet against America? Now, I don't know when the headline's going to come out that China has surpassed the US's lead in AI. That could happen one day. And that's a risk to AI. That's going to be, that's going to cause AI stocks to potentially sell off, right? That's going to be another DeepSeek moment. And boom, okay? Then that fuels another round of, oh shit, we got to compete. Like, we got to get moving. Governments are going to get involved, okay? These things are into the future. They are not happening right now. So when you look at Tesla, the stock held up well today. The stock had good news today. The stock was up 2.4%. Things look pretty good. I actually think a breakout could be coming. Look at this blue line here, the 20-day moving average. Every time Tesla breaks above the 20-day moving average, the stock goes into a very large rally. Okay? What happened today? The stock broke above the 20-day moving average and closed above that. That is a very strong indicator that we could be going through the next leg higher anytime now. Anytime now. And you need to be prepared for that to happen. Now, again, I'll say this for like the 10th time on this channel. I'm bullish on 2026. Okay, I think inflation is going to come down. I think we're going to get multiple Fed rate cuts. I think we're going to get a bullish Fed chair. I think we're going to have the consumer and the economy getting better. That's a pretty powerful backdrop. Add on to that AI and the possibilities that are going to emerge with that and the use cases that will continue to grow and the competition there. And you could start to see a very optimistic 2026, okay? I don't think regional banking issues with certain loans are going to be an issue. I don't think the government shutdown is going to be an issue 12 months from now or 6 months from now. It's going to be a lost thought, right? It's going to be irrelevant to your portfolio. You're not going to look back and say, damn, I wish I sold during the banking crisis, in my personal opinion. That's my expectation for 2026. That's why I'm viewing this opportunity, even in some of the AI stocks we're investing in, some of the healthcare, gene editing companies, quantum companies that we're investing in, as planting opportunities. This is just a moment of fear, in my personal opinion, to double down on some of those positions that you have a lot of belief in. Now, not all companies are created equal, okay? Some of those energy companies that are, again, going to take a decade to start showing revenues, that are trading at multi-billion-dollar valuations that you can't logically justify. Like, you want to be a little selective. You always want to be a little selective in the stocks that you are choosing. That does not change right now, okay? But the core thesis on AI, the core thesis on the economy next year, the core thesis on markets has not changed. In fact, after today, China-U.S. trade relations seem to have gotten a little bit better. The case for buying the dip today, I will say, got even a little bit stronger, and that's why we did do more buying today. Now, if you guys want to come join the trading community, check that link out down below in the description of today's episode. Again, these themes, AI, healthcare, gene editing, robotics, quantum, software, you get the idea. A lot of these themes are in the early stages of what I believe will be a 10-year bull market for these areas. Yes, there's going to be waves. Sometimes one area is going to do better than others. You get the idea. But I think we are in a secular bull market for these themes. And we are going out finding these smaller cap companies that are hidden gems, if you will, the Palantirs at $10, if you will, and investing in those companies that will one day, in my opinion, be much larger companies. Obviously, it's not financial advice. It's not a recommendation. Come to your own conclusions. But that is the strategy I think right now offers the best risk to reward. And that is how we have been able to outperform all hedge funds and institutions this year. The trading community portfolio, even after the last week of trading, if you will, that has been so bad for a lot of AI stocks, we are still up over 150% year to date. Okay? We are still killing it. So if you'd like to come join us, check that link out down below in the description of this video. If you also want to join Public, that is where I have my largest brokerage, well over 6 figures. I love Public. It's like a better version of Robinhood, in my opinion. If you sign up with the link down below, deposit $1,000, you will get $100 in free stock of your choice, and I will get $100 of free stock of my choice. It's a win-win for both of us involved. Check it out, link down below if you guys would like to. But I do want to share this clip with you on CNBC. I thought it was so powerful that I even shared this with the trading community. I said, look, guys, you have to listen to this clip. That was last night, and it holds relevant, this is really going to be a relevant clip a month or two from now, because they're talking about an AI bubble and how really we're not seeing an AI bubble. Okay? And I think, personally, Tesla stock and some of our other favorite stocks could be on the rebound pretty soon. But first, before we talk about that, let's take a listen to what Renaissance Macro's Jeff DeGraff says about this market and about a bubble.
To what's happening in yields, because I know you're watching those closely. Where's the next stop?
Well, the 10-year, I think that the yields trade down to about 388 or so, and then from there it's about 370. I'd feel comfortable with yields doing what they should do, anywhere between here and 360. Under that, and that starts to get a little uncomfortable from what the market's message is about the economy. But I actually think this is really good news. Because it implies that the inflation that people are concerned about probably isn't a problem, at least from the market's perspective. And keep in mind, we've got this dearth of information because of the government shutdown. So, we're kind of trading in a vacuum here as far as the macro data is concerned, at least.
You say that the move lower supports the quote-unquote, we ain't seen nothing yet, potential for this market. Is that because, okay, it just supports the whole notion yields are coming down, Fed's cutting rates, economy's hanging in, and then it's off to the races like some are projecting this market could go?
I think that is spot on. I think the risk to the market is that the economy, the real economy, is weaker. It gives the Fed all the cover they need to cut rates. And as you said, we ain't seen nothing yet if that's the case.
Yeah, Mike, it's interesting. I know you listen and read Jeff's stuff. What do you think about that? It's only going to get people more excited if they are convinced that rates are coming down while the economy is still okay.
That's right. No, and it's while the economy is still okay. So the whole premise of why we got here, right? Why we got to 67.50 or whatever on the S&P was because Fed was going to be cutting. It was going to be the second annual soft landing execution successfully, and it wasn't. And that we also have this sustainable disconnect between job growth and GDP. And we also have the ingredients for a reacceleration next year. I agree with all that. That's why we're where we are. Regional banks can't go down every day like this and have that story be intact. I'm not panicking out of it, but you have to pay attention to whether, in fact, the market is starting to get nervous that you're seeing some stress points in either the real economy or, the funding markets or something like that. We've had more false alarms than real alarms over the past few years in that, but I do think you have to at least pay attention to it. And that is, in the absence of official data, what you have to struggle with, exactly what the trajectory of the real economy is.
What about that, Jeff? The idea of these regional banks, top of the headlines, the alts managers, top of the headlines, the stocks of all of those together are not trading well.
No doubt about it. I mean, I don't worry about the regionals so much. I think there's a little bit of a disconnect there. The alts are far more advanced in terms of a topping pattern. As Mike said, is this a false alarm? Is this issue specific to First Brands and the like? We'll see. I mean, clearly the growth in credit was from the private side over the last 10, 15 years. So, if you're going to look for a spot where there might be trouble and, maybe a little lowering or lax standards, I think that's exactly where you'd want to look. So, look, I'm personally, we're short these things as the hedge against the bullish call. But keep in mind, perversely, if it is bad enough and it gives the Fed more fodder, that's, again, still good for these stocks, particularly these concentrated stocks, as this kind of blue sky narrative continues to play out and probably build.
Yeah, don't fight the Fed has broad meaning to many, doesn't it? What about the gold? Are you watching gold, and what are the charts telling you? Now I'm hearing 5,000. Before it was 4,000. Now it's 5.
Yeah, look, I think gold is certainly in an uptrend, and we're hearing a lot of talk about bubbles in the equity markets. I don't think if it is, we've only just begun. Some of the things that we look at for gold, this kind of excess alpha that we look at, we are now rivaling where we were back in 1990. So, with that doesn't mean sell it. What that means is that, hey, we're likely entering a bubble phase, and so I need to be very, very careful about how I play that. Which is, I don't want to be in a FOMO position, right? In other words, I don't want to be playing from a position of weakness, in these types of environments. So you hold on tight, you look for it, you peel some of this off systematically. Everybody talks about dollar cost averaging. We talk about dollar cost selling when we get in these environments, but that's just begun for gold. And I think that's important.
So yeah, with all of this talk of a bubble, basically everywhere you look, people are saying, "Oh, we're in a bubble, top's coming." No, some of the, smartest people, some of the best research firms like Renaissance Macro Research say if this is a bubble, we haven't seen anything yet. This is not even close to the top of a quote-unquote bubble. And I think the markets are even voting in the last couple of days. You can see Tesla stabilized back on October 10th and has been rising ever since. Yes, slowly but surely is really validation that Tesla is the place you want to be. Specifically for Tesla, there's a lot of upcoming catalysts, robotaxi expansions and new cities coming, or new countries and new markets. Maybe it's Tokyo, maybe it's, who knows, right? Canada, places in Europe, maybe it's China. Right, that gets robotaxi operations. There is many catalysts coming there. I think Wall Street is wrong in expecting Q4 to be a really bad quarter for Tesla. I think it's going to be much better than expected. Shareholder meeting, getting Elon's compensation package approved, an investment into XAI, earnings next week, which could deliver some surprises. More rate cuts again into 2026 that really benefits anything to do with financing. 80% of vehicles are financed on average. Like, there's a lot of tailwinds here for Tesla, and we haven't even got into any kind of AI robotic euphoria, which Tesla is going to be a leader in that euphoria when it does come. I actually like the idea of buying Tesla at these levels. For the upside potential. Now, I wish the stock would come down alongside other AI stocks, but I think it's really just a testament to Tesla has a lot of upcoming catalysts. It's in the right area at the right time, seeing a lot of momentum in the business. Their business is firing on all cylinders. And, yeah, that's good for Tesla, especially in this market environment. So let me know your thoughts on this down below in the comment section. Honestly, with the technical setup we have, closing above the 20-day moving average, historically that leads to quite a rally. Maybe not initially. The last time we broke above the 20-day moving average, it took 1, 2, 3, 4 days before we actually had, an aggressive breakout. Like, maybe it takes a couple of days, but I think a larger breakout for Tesla could be coming, and it might even be next week on Tesla's earnings. So be on the lookout for that. Ladies and gentlemen, hit the like button as well as subscribe to the channel. Check that link out down below in the description of this video if you'd like to. Again, come join the trading community. Have a great rest of your day, and I will see you in the next one.